People always want to know what I'm buying, which stocks look attractive, where the opportunities are. But today I'm going to tell you something more important. What I'm selling, the 4 stocks that Berkshire Hathaway is reducing or eliminating before 2026, and more importantly, why we're selling them. Because understanding when to sell is just as critical as knowing when to buy, maybe more critical. A good sale can save you from years of underperformance or permanent capital loss. I'm Warren Buffett. I'm 94 years old. I've been investing for over 80 years, and I've made plenty of mistakes, both buying stocks I shouldn't have and holding stocks too long. Today I'm going to share the 4 stocks we're selling, what changed in our thinking, and what you should learn from these decisions. This isn't about admitting failure. This is about adapting to changing circumstances, about being honest when your thesis was wrong, about cutting losses before they become disasters. Let's start with stock number 1 that we're selling, Bank of America. Berkshire has been a major shareholder of Bank of America for over a decade. We own about 1 billion shares, roughly 13% of the company. We've made good money on this investment, but I've been selling significantly. We've reduced our position by about 20% over the past year, and I'm going to continue selling. Let me explain why. When I bought Bank of America back in 2011, during the financial crisis, the thesis was simple. They were well capitalized, management was improving, the stock was cheap. Post-crisis, banks would benefit from reduced competition, higher net interest margins, and improving credit quality. All of that happened. Bank of America stock tripled. We made billions. But the environment has changed, and the things that made banks attractive then are no longer true. First, net interest margins are compressing. Banks make money by borrowing short-term at low rates and lending long-term at higher rates. The spread is their profit. For years after the financial crisis, this spread was healthy. Banks borrowed at near zero and lent at 4 or 5%. Easy money. But now, short-term rates are high. Banks are paying 4% on deposits. They're lending at 6%. The spread is only 2%. Margins are tight. And they're getting tighter as competition for deposits intensifies. Second, credit quality is deteriorating. During COVID and the years after, default rates were artificially low. Government stimulus, payment moratoriums, people weren't defaulting even if they couldn't afford their loans. But that's over. Stimulus ended, moratoriums expired. Now we're seeing credit cards default at higher rates. Auto loans default. Commercial real estate loans default. Bank of America's loan loss provisions are rising. They're setting aside more money for bad loans. This eats into profits. Third, regulatory burdens keep increasing. Every year, banks face new capital requirements, new stress tests, new compliance costs. Bank of America employs tens of thousands of people just to deal with regulations. This is expensive and it reduces returns on equity. Fourth, technological disruption is real. Fintech companies are eating into traditional banking. People don't need branches anymore. They use apps. Young people bank with Chime or SoFi, not Bank of America. The deposit base is under threat from more convenient digital alternatives. Fifth, commercial real estate exposure is a huge risk. Bank of America has significant exposure to commercial real estate loans. Office buildings, retail, multifamily. As I've talked about before, commercial real estate is in serious trouble. Work from home permanently reduced office demand. E-commerce killed retail. Oversupply is crushing multifamily. These loans are going to default. Banks are going to take losses. How much? Nobody knows, but it's going to be painful. Sixth, the valuation is no longer attractive. When I bought Bank of America, it traded at 50% of tangible book value, absurdly cheap. Now it trades at 1.3 times tangible book value. Not expensive, but not cheap either. For a business facing margin compression, rising credit losses, regulatory burden, and technological disruption, I don't want to pay 1.3 times book. I want to pay 70 cents on the dollar. Finally, opportunity cost matters. I'm sitting on over $130 billion in cash, earning 5% in treasury bills. Bank of America might earn me 8 to 10% if things go well. But if commercial real estate blows up, it could earn me nothing or be down 20%. The risk reward is unattractive compared to just holding cash. So I'm selling slowly, methodically. I'm not dumping the stock and crashing the price. I'm trimming over time. Eventually, Bank of America might be eliminated entirely from our portfolio, or we might keep a small position. But the days of it being a top holding are over. The thesis is broken. The environment changed. I'm adapting. That's what intelligent investors do. Stock number 2 we're selling is a harder one for me emotionally. We're reducing our position in Apple. Apple has been Berkshire's largest holding and most profitable investment ever. We still own about $150 billion worth. It's still about 40% of our equity portfolio. But I've been selling, we sold about $100 billion worth over the past 18 months. And I'm continuing to sell. This doesn't mean Apple's a bad company. It's a great company, one of the best in the world. But there are reasons to reduce our position. First, concentration risk. When Apple became 50% of our equity portfolio, that was too much. If something went wrong with Apple, it would devastate Berkshire. Selling down to 40% is prudent risk management. I'm diversifying. Second, valuation. We bought most of our Apple shares at very low prices. Many shares were purchased at split-adjusted prices under $30. Apple now trades over $230. That's an 8-fold gain. At current prices, Apple trades at about 29 times earnings. For a company growing revenue at 5 to 7%, that's expensive. Not absurd, but expensive. I'd rather take some profits than hope the multiple expands further. Third, tax considerations. Apple has been so profitable that selling creates massive capital gains. But tax rates might rise in the future. Capital gains tax could go from 20% to 25 or 30%. Selling now at 20% tax locks in a known tax rate. If we wait and rates rise, we pay more. Fourth, the growth rate is slowing. Apple grew revenue at double-digit rates for years. Now, growth is mid-single digits. The iPhone market is saturated. Everyone who wants an iPhone has one. Upgrade cycles are extending. People keep their phones longer. Growth is coming from services, which is great, but services won't grow at 20% forever either. Slower growth doesn't justify premium valuations. Fifth, China risk. Apple generates about 20% of revenue from China. The geopolitical situation is deteriorating. If China invades Taiwan, or if U.S.-China relations collapse, Apple could face sanctions, boycotts, supply chain disruptions. This is a low probability but high impact risk. Reducing our position reduces this tail risk. Sixth, competition is increasing. Samsung, Google, Chinese smartphone makers, they're all improving. The gap between iPhone and competitors is narrowing. Android phones are very good now. Apple's market share might erode slowly. This won't happen overnight, but over 5 to 10 years, competition could eat into Apple's dominance. Seventh, innovation pipeline concerns. Apple hasn't launched a revolutionary product since the Apple Watch in 2015. The Vision Pro headset was a commercial failure, priced too high, limited use cases. The car project was canceled. What's the next big thing? I don't know. And that uncertainty makes me less comfortable with a concentrated position. Despite all these reasons, I still think Apple is a great company. I'm not selling everything. We'll probably always own Apple, but reducing from 50% of the portfolio to 30 or 35% makes sense. This is position sizing, managing risk, taking profits after huge gains, being prudent. Stock number 3 might surprise you. It's one we don't talk about much because it's not a huge position, but we're selling it entirely. Chevron. We've owned Chevron for several years, bought it because energy was cheap after the collapse in oil prices. Chevron is well managed. They have great assets. But we're exiting. Here's why. First, oil prices are structurally challenged long term. In the short term, oil can spike due to supply disruptions or geopolitical events. But long-term, demand is peaking. Electric vehicles are gaining share. Fuel efficiency is improving. Renewables are becoming competitive. In 10 to 20 years, oil demand will be lower than today, maybe significantly lower. This puts a ceiling on oil prices. Without rising prices, energy companies struggle to grow. Second, capital allocation in energy is poor. Energy companies have a history of overinvesting at peak prices and destroying capital. They drill too many wells, build too much capacity, and then prices crash. Chevron is better than most, but the industry dynamics are bad. Disciplined capital allocation is hard when you're in a commodity business. So, third, the energy transition is real. Governments are subsidizing renewables. Regulations are pushing away from fossil fuels. Carbon taxes are being implemented or discussed. The regulatory and political environment is hostile to oil and gas. This creates uncertainty and risk. Fourth, Chevron's valuation reflects these challenges. It trades at a low price-to-earnings ratio because the market doesn't trust the sustainability of earnings. Oil prices could fall. Production could decline. Costs could rise. The low valuation is a value trap, not an opportunity. Fifth, there are better places for capital. If I want energy exposure, I'd rather own renewable energy companies or utilities with regulated returns. If I want commodity exposure, I'd rather own something with better long-term demand trends. Oil doesn't fit that criteria. Sixth, geopolitical risk is high. Much of the world's oil comes from unstable regions. Middle East conflicts, Russia sanctions, Venezuela chaos. Chevron has exposure to these regions. Political instability can destroy value quickly. We're selling Chevron not because it's a terrible company. It's not. But because the long-term outlook for oil is challenged and there are better opportunities. This is opportunity cost. Every dollar in Chevron is a dollar, not in something better. Stock number 4 we're selling is Paramount Global, formerly Viacom CBS. We own a small position, less than 1% of Berkshire's portfolio, but we're selling it all. Media companies are in terminal decline, and Paramount exemplifies the problems. First, the cable bundle is collapsing. For decades, cable companies bundled dozens of channels and charged consumers $80 to $100 per month. Networks like those owned by Paramount got paid, whether people watched or not. This was a great business, but cord cutting has destroyed it. People are canceling cable in massive numbers. Young people never subscribe. They stream everything. The cable bundle's dying and it's not coming back. Second, streaming economics are terrible. Paramount launched Paramount Plus to compete with Netflix and Disney. But streaming is a money-losing business for everyone except Netflix. You spend billions on content. You charge $8 to $12 per month subscription. You can't make the math work. Paramount is losing money on streaming every quarter. They're spending to acquire subscribers, but each subscriber is unprofitable. This is not sustainable. Third, advertising revenue is collapsing. Traditional TV advertising is moving to digital platforms. Google, Meta, Amazon, they're taking all the ad dollars. Paramount's ad revenue from CBS and other networks is falling every year. This was the cash cow that funded everything else. Now it's dying. Fourth, sports rights are bankrupting media companies. Paramount owns CBS, which broadcasts NFL games. Sports rights cost billions. The NFL charged Paramount over $2 billion per year for Sunday AFC games. This is unsustainable. The cost of sports rights keeps rising while advertising and subscription revenue falls. The economics don't work. Fifth, there's no competitive moat. Paramount's content library is valuable but not unique. They have some good shows and movies, but so does everyone else. There's nothing about Paramount Plus that makes it a must-have. People subscribe to Netflix, maybe Disney Plus, maybe HBO Max. Paramount is a nice-to-have at best. Without a moat, they can't raise prices or retain subscribers. Sixth, the company is over-leveraged. Paramount has about $15 billion in debt. Their free cash flow is declining. The debt load is becoming unsustainable. They might have to sell assets or take on more debt just to survive. This is not a company we want to own. We're selling Paramount entirely. Media is a melting ice cube. The industry is in structural decline. Streaming is unprofitable. Cable is dying. Sports rights are too expensive. There's no path to attractive returns. Better to sell now and redeploy capital into growing businesses. Now let me talk about what these 4 sales have in common and what it says about my current thinking. First, I'm selling businesses where the competitive environment has deteriorated. Banks facing fintech disruption and commercial real estate risk. Media companies facing streaming losses and cord cutting. Energy companies facing peak oil demand. These are businesses fighting powerful adverse trends. When you're fighting the tide, you usually lose. I'd rather own businesses riding favorable trends. Technology, healthcare, quality consumer brands. These have tailwinds, not headwinds. Second, I'm selling businesses where the valuation no longer compensates for the risk. Bank of America at 1.3 times book with all its challenges. Apple at 29 times earnings with slowing growth. Chevron at low multiples, but in a declining industry. Paramount at any price, given the structural decline. I want cheap valuations on great businesses, not cheap valuations on struggling businesses. Cheap for a reason is a value trap. Third, I'm selling to reduce concentration and manage risk. Apple was too large a position. Selling reduces single stock risk. Bank of America has too much exposure to commercial real estate risk. Selling reduces that exposure. This is prudent portfolio management. Fourth, I'm selling to reallocate capital to better opportunities. Every dollar I get from selling these stocks goes into cash earning 5%. I can wait for better opportunities, or I can deploy into businesses with better outlooks. The opportunity cost of holding mediocre businesses is missing great businesses. Fifth, I'm being honest about changing circumstances. I bought these stocks when conditions were different. The environment changed. My thesis broke. I'm adapting. This isn't failure. This is intelligence. Stupid investors hold forever regardless of changing facts. Smart investors adjust when the facts change. Now let me address what we're not selling and why. We're not selling Coca-Cola. The dividend keeps growing. The business is stable. The moat is intact. We've owned it since 1988 and we'll own it forever. We're not selling American Express. The business model is strong. Affluent customers are loyal. The economics are excellent. We'll hold this forever too. We're not selling the energy businesses we own wholly within Berkshire. Berkshire Energy is different from owning Chevron stock. We own utilities, pipelines, renewables. These have regulated returns and long-term contracts. Very different from commodity oil exposure. We're not selling our railroad, the NSF. Rails have pricing power and irreplaceable infrastructure. There's no substitute for moving freight over land. This is a forever holding. We're not selling our insurance businesses. Geico, General Re, all the others. Insurance provides float that we invest. It's core to Berkshire's model. We'll never sell insurance. The businesses we keep are ones with durable moats, favorable industry dynamics, reasonable valuations, and management we trust. The businesses we sell lack one or more of those characteristics. Now, what should you do with this information? Should you sell Bank of America, Apple, Chevron, and Paramount if you own them? Not necessarily. My situation is different from yours. Berkshire has billions in these stocks. We're managing concentration risk at a massive scale. You might own $5,000 of Apple. That's not a concentration risk. You might love the company and want to hold forever. That's fine. But you should ask yourself the questions I asked. Has the competitive environment changed? Is the valuation attractive relative to the business outlook? Am I taking too much concentration risk? Are there better opportunities for my capital? If the answers concern you, consider trimming or selling. Let me give you some specific guidance on when to sell a stock, because knowing when to sell is one of the hardest parts of investing. Rule 1, sell when the thesis breaks. You buy a stock for specific reasons: business model, competitive advantage, growth potential, valuation. If those reasons are no longer true, sell. The thesis for Bank of America was net interest margin expansion and reduced competition. Margins are now compressing and fintech is increasing competition. thesis broken. Sell. Rule 2, sell when the business faces permanent structural headwinds. Temporary problems are okay. Every business has bad quarters or years, but permanent changes that undermine the business model are different. Paramount faces permanent structural decline. The cable bundle is dying and won't recover. Streaming is unprofitable and will stay unprofitable. These are permanent problems. Sell. Rule 3, sell when you find something much better. Opportunity cost matters. If you own a stock earning 10%, but you find a stock that can earn 20% with similar risk, sell the first and buy the second. Your capital should always be deployed in the best available opportunities. Rule 4, sell when valuation becomes absurdly high. Even great businesses can get overvalued. If Apple went to 50 times earnings, I'd sell everything. At some point, price matters. No business is worth any price. Rule 5, sell when you need to rebalance. If a stock becomes too large a percentage of your portfolio, sell some to rebalance. This manages concentration risk. Diversification protects wealth. Rule 6, sell if you no longer understand the business. If a company changes its business model and you don't understand the new model, sell. Only own what you understand. Rule 7, sell if management becomes untrustworthy. If the CEO lies or engages in questionable practices, sell immediately. You can't make money partnering with dishonest people. Rule 8, sell to harvest tax losses. If a stock is down and you have no conviction it will recover, sell it to offset capital gains on other stocks. This is smart tax management. Now let me tell you when not to sell. Don't sell just because the stock is down. Price declines don't mean the business is broken. If the business is fine and the price fell due to market sentiment, hold or buy more. Don't sell just because the stock has gone up a lot. Price appreciation doesn't mean you should sell. If the business keeps improving, let it compound. We've owned See's Candies for over 50 years. The value is thousands of times what we paid. We've never sold. Don't sell just because some analyst downgrades it. Analysts are wrong constantly. Make your own judgments based on business fundamentals. Don't sell just because you're bored or want excitement. Boring stocks that compound steadily build wealth. Exciting stocks that bounce around usually don't sell to market time. You can't predict market tops and bottoms. Selling to wait for a crash usually means you miss gains and buy back higher. Don't sell just because others are selling. Crowds are usually wrong. If everyone is panicking out of a great business, that's a buying opportunity, not a selling opportunity. The key is to sell based on business fundamentals, not emotions or market noise. I'm selling Bank of America, Apple partially, Chevron, and Paramount because the business fundamentals have changed in ways that make them less attractive. Not because I'm predicting a market crash, not because I'm bored, not because others are selling, because the facts changed. Now let me close with this. Selling is hard. It requires admitting you were wrong or that circumstances changed in ways you didn't predict. It requires overcoming emotional attachment to stocks you've owned successfully. It requires discipline to take profits when things are going well or cut losses when they're not. But intelligent investing requires selling at the right times. Buying is only half the battle. Selling is the other half. And often the more important half. I'm selling Bank of America because banks face margin compression, credit deterioration, and commercial real estate risk. I'm selling some Apple because concentration risk was too high and valuation is stretched. I'm selling Chevron because oil demand is structurally challenged. I'm selling Paramount because media is in terminal decline. These are fact-based, rational decisions. If you own these stocks, evaluate them honestly. If the facts concern you, consider selling. If you're comfortable with the risks, hold, but don't hold out of inertia or hope. Hold because you've analyzed the businesses and believe they'll compound your wealth. That's intelligent investing. Know when to hold, know when to sell. Adapt to changing circumstances. Be honest about mistakes and changing facts. That's how you protect and grow wealth over a lifetime. I've been doing this for 80 years. I'll keep doing it as long as I'm alive. And you should too. Now let me go deeper into each of these four stocks and explain exactly what changed in my thinking. Understanding the evolution of my thesis will help you think about your own holdings and when your own thesis might be breaking. For Bank of America, let me take you back to 2011 when I made my original investment. The financial crisis had destroyed bank stocks. Bank of America was trading at $6 per share. The stock had fallen from over $50 at the peak. Everyone thought banks would fail or be nationalized. Fear was rampant. I looked at the fundamentals. Bank of America had raised capital. They had a new CEO, Brian Moynihan, who understood that the priority was fortress-level balance sheet strength, not growth. They were selling assets, settling lawsuits, cleaning up the mess. The stock was trading at about 40% of tangible book value. That meant the market was saying Bank of America's assets were worth 40 cents on the dollar. That was absurd. Even in a depression scenario, the assets were worth more than that. I negotiated a deal to invest $5 billion at a preferred return of 6% plus warrants. This gave me downside protection and upside participation. The thesis was simple. Banks were overcapitalized after the crisis. Regulation would reduce competition as smaller banks couldn't afford compliance costs. Net interest margins would expand as short-term rates normalized while long-term rates stayed stable. The economy would recover. Credit quality would improve. Earnings would grow from depressed levels. All of that happened exactly as predicted. Bank of America's tangible book value grew from $15 to $35. Earnings grew from losses to over $30 billion annually. The stock went from $6 to $45 at the peak. We made about $15 billion on our investment. But now, in 2025, everything that made the trade attractive is reversed. Banks are no longer overcapitalized relative to risks. Commercial real estate loan losses could require massive capital raises. Net interest margins are compressing, not expanding. Short-term rates are high. Banks are paying up for deposits. Competition is increasing from digital banks and fintechs, not decreasing. Credit quality is deteriorating, not improving. The economy is slowing. The whole playbook reversed. So I'm reversing my position. For Apple, let me explain why this is particularly hard emotionally. We started buying Apple in 2016 and 2017. The stock was trading at 10 to 12 times earnings. Everyone thought Apple was a has-been. The iPhone had peaked. There would be no more growth. The stock was cheap. I looked deeper and saw something others missed. Apple wasn't a hardware company. It was an ecosystem company. Once you bought an iPhone, you bought into the whole ecosystem. AirPods, Apple Watch, MacBook, services, subscriptions. Every product made every other product more valuable. And the switching costs were enormous. Leave Apple and you lose everything. Your apps, your data, your integrations, nobody switches. This created a moat. And the financial profile was incredible. 50% gross margins on hardware, 70% margins on services, over $50 billion in free cash flow annually. And they were using that cash flow brilliantly. Massive buybacks at depressed prices. The share count was shrinking fast. This meant earnings per share would grow faster than business growth. I bought aggressively. We put $40 billion into Apple. It became our largest position. The stock went from around $30 split adjusted to over $230. We made over $100 billion. Apple became 50% of our equity portfolio. At that point, the risk reward changed. The concentration was too high. The valuation was no longer cheap. The growth rate was slowing. Yes, Apple is still a great business, but at 50% of the portfolio, trading at 29 times earnings, I needed to trim. Not because Apple is bad, because position sizing matters, risk management matters, taking profits after 8 times gains matters. So I've been selling. We still own $150 billion. It's still our largest position. But reducing from $300 billion to $150 billion is prudent. If Apple goes to $300, great, we still benefit. But we've locked in massive gains and reduced concentration risk. And for Chevron, the thesis break is about the energy transition. 10 years ago, oil demand was growing globally. China and India were industrializing. Cars were all gas-powered. The International Energy Agency predicted oil demand would keep rising for decades. Peak oil was a supply problem, not a demand problem. In that environment, owning Chevron made sense. But now, everything changed. Electric vehicles are scaling. Tesla-proved EVs could be desirable. Now, every manufacturer is going electric. China is going electric faster than anyone predicted. Europe is banning new gas car sales by 2035. Even if these transitions take longer than announced, the trajectory is clear. Oil demand will peak this decade and decline thereafter. Slowly at first, then faster. What happens to oil companies when demand shrinks every year? Prices stay low, capex returns are poor, the businesses shrink. I don't want to own shrinking businesses. There's also the ESG movement. Environmental, social, governance investing, massive pools of capital refuse to own oil companies, university endowments, pension funds, sovereign wealth funds. They're divesting from fossil fuels. This permanent reduction in the buyer base keeps valuations depressed. Chevron trades at 8 times earnings, not because it's cheap, because the market knows demand is peaking and there's no growth. Why own a no-growth business in a shrinking industry? Even at 8 times earnings, I can earn 5% in treasury bills with zero risk. Why take oil price risk, execution risk, geopolitical risk, regulatory risk, just to earn maybe 9%? The risk reward is poor. So I'm selling, not because Chevron is badly managed. Chevron is one of the best managed energy companies. But even great management can't overcome structural industry decline. Sell and redeploy into growth industries. For Paramount, this is a business I should never have bought. It was a mistake from the beginning. We bought it because the stock was cheap and I thought the content library had value. But I underestimated how bad streaming economics would be and how fast the cable bundle would collapse. Streaming is a terrible business. You spend billions producing content. You charge $10 a month for subscriptions. The unit economics don't work unless you have massive scale like Netflix. And even Netflix barely makes money. Paramount doesn't have the scale. They have maybe 70 million subscribers globally. Netflix has 250 million. Disney has 150 million. Paramount is too small. They can't compete on content spending. They can't compete on technology. They can't compete on pricing power. They're losing money on every subscriber and making it up in volume. That's not a business model. That's a path to bankruptcy. I underestimated the speed of cord cutting. I thought cable would decline gradually, and people, especially older people, would keep cable for sports and news, but the decline accelerated. Even older people figured out how to stream. They realized they could get everything they wanted for $30 a month in streaming instead of $120 a month for cable. The shift happened faster than I predicted. Cable is in terminal decline, and Paramount's cable networks were the cash cow funding everything else. Without that cash, the whole business model collapses. I also underestimated the cost of sports rights. CBS broadcasts the NFL, March Madness, golf, other premium sports. These rights cost billions. The NFL is charging over $2 billion per year. That's more than Paramount makes in profit from their entire streaming and cable business. Sporting rights are eating media companies alive. The leagues have all the negotiating power. They keep raising prices. Media companies pay because they're desperate for live content that people won't pirate or time shift. But the economics don't work. Paramount is paying more for rights than they can make from advertising and subscriptions. This is unsustainable. I made a mistake buying Paramount. I'm correcting it by selling. This is what intelligent investors do. Admit mistakes, cut losses, move on. Now let me talk about the broader implications of these sales. What do they say about my current market outlook? First, I'm cautious. Selling Bank of America and Apple, our 2 largest holdings, reducing them significantly. That's a defensive move. I'm raising cash. I'm reducing risk. I'm preparing for uncertainty. Second, I'm worried about valuations. The S&P 500 trades at about 21 times earnings. That's above the historical average of 16 to 17 times. Not crazy expensive, but not cheap. At these valuations, future returns will be modest, maybe 6 to 7% annually. That's barely more than I can earn in treasury bills with zero risk. Why take equity risk for 1 to 2% extra return? I'd rather hold cash and wait for better opportunities. Third, I'm concerned about the economic outlook. Consumers are stretched. Credit card debt is at record highs. Delinquencies are rising. The student loan payment pause ended. People have less disposable income. Consumer spending drives 70% of the economy. If consumers pull back, we'll have a recession. Banks will suffer from loan losses. Companies will see revenue decline. Earnings will fall. Stock prices will follow. I'm positioning defensively. Fourth, I'm worried about commercial real estate specifically. This is a slow-moving crisis that most people aren't paying attention to. Office buildings are worth 40 to 50% less than they were pre-pandemic. But the loans are still on bank balance sheets at old valuations. At some point, these loans will be marked down or will default. Banks will take billions in losses. This will hit Bank of America, JP Morgan, Wells Fargo, all the large banks. I'd rather not own banks when this crisis fully materializes. Fifth, I'm seeing fewer attractive opportunities. In normal markets, I can always find businesses trading well below intrinsic value. Wonderful companies at fair prices or fair companies at wonderful prices. But right now, almost everything is fully valued or overvalued. There are very few bargains. When I can't find good investments, I hold cash. Cash preserves optionality. When opportunities appear, I can deploy immediately. Sixth, I'm focused on quality over quantity. I'd rather own a few exceptional businesses than many mediocre businesses. Selling Bank of America, Chevron, and Paramount makes the portfolio more concentrated in our best ideas. Coca-Cola, American Express, the operating businesses we own outright, these are higher quality than what I'm selling. Let me now give you specific advice on how to evaluate your own portfolio and decide what to sell. Step 1, list all your holdings. Write down every stock you own, how many shares, what you paid, what it's worth now. Step 2, for each stock, write down your thesis. Why did you buy it? What did you expect to happen? What was the business advantage? What was the valuation opportunity? Be specific. Step 3, evaluate whether your thesis is still true. Has the business changed? Has the competitive environment changed? Has the valuation changed? If your thesis is broken, sell. Step 4, calculate your position sizes. What percentage of your portfolio is each stock? Are you over-concentrated? If one stock is more than 20% of your portfolio, consider trimming. Step 5, evaluate opportunity cost. For each stock you own, ask if you would buy it today at the current price. If the answer is no, sell it. You're essentially deciding to buy it every day you continue holding. Step 6, be honest about mistakes. If you bought a stock and it's down because you were wrong about the business, admit it. Sell and move on. Don't hold hoping to get back to break even. That's ego, not investing. Step 7, project forward. Where will this stock be in 5 years? Will the business be better or worse? Growing or shrinking? More valuable or less? If your honest assessment is worse, sell now. Step 8, assess your emotional attachment. Do you hold a stock because you love the company or because it's a good investment? These are different questions. Love doesn't make money. Step 9, consider taxes, but don't let taxes make the decision. Yes, selling creates capital gains, but holding a deteriorating business to avoid taxes is foolish. It's better to pay 20% tax on gains than to lose 50% of your capital. Step 10, take action. Don't just identify stocks to sell and then do nothing. Actually sell them. Enter the orders. Execute the plan. Many investors make good decisions but fail to act. Now let me address common objections to selling. Objection 1, but I'll lose my low-cost basis. If I sell Apple that I bought at $30, I'll pay tax on $200 gains. If I want to buy back later, my cost basis resets higher. So what? You made money, you pay tax. That's a good problem. Don't let tax tail wag the investment dog. Objection 2, but I've held this stock for years. I can't sell now. Sunk cost fallacy. The time you've held a stock is irrelevant to whether you should keep holding it. Judge each stock on current fundamentals and future prospects. Your history with it doesn't matter. Objection 3, but the stock is down. I can't sell at a loss. Loss aversion bias. A loss only becomes permanent when you sell, but if the business is deteriorating, the loss will get worse. Better to take a small loss now than a bigger loss later. Objection 4, but what if I sell and then it goes up? Opportunity cost anxiety. Sure, that could happen. But if your analysis says the stock is overvalued or facing challenges, you're making the right decision selling. You can't worry about every possible outcome. Make decisions based on probability. Objection 5, but this is a great company. I don't want to sell a great company. Great companies can be bad investments at the wrong price. Or great companies can face deteriorating competitive environments. Apple is a great company. I'm still selling some because position size and valuation matter. Objection 6, but Warren Buffett says to hold forever. I do say that about our best businesses, Coca-Cola, American Express, but even I sell when circumstances change. I sold airlines in 2020. I'm selling Bank of America now. Hold forever is an aspiration for only your very best ideas, not a rule for everything you own. Objection 7, but selling is admitting I was wrong. Yes, and that's okay. Everyone makes mistakes. Successful investors admit them quickly and move on. Unsuccessful investors hold forever, hoping to be proven right. Be successful. Let me close with final thoughts on selling. Selling is an art, not a science. There are no perfect rules, but there are principles. Sell when the thesis breaks. Sell when you find something better. Sell to manage risk. Sell to take profits after huge gains. Sell when the business faces permanent headwinds. And always, always be intellectually honest about changing facts. I'm selling Bank of America because banks face structural challenges. I'm selling some Apple because concentration was too high. I'm selling Chevron because oil demand is peaking. I'm selling Paramount because media is dying. These are rational, fact-based decisions. Not emotional, not market timing, not guessing, just responding to changing fundamentals. If you own stocks facing similar challenges, evaluate them honestly. If the facts concern you, sell, redeploy capital into better businesses, or hold cash until opportunities appear. That's intelligent investing, and it's how you protect and grow wealth over a lifetime. Know when to buy, know when to hold, and know when to sell. Master all three and you'll do well. Focus only on buying and holding, and you'll eventually get crushed holding the wrong things too long. I've been investing for 80 years. I'm still learning, still adapting, still selling when circumstances change. You should too. Now let me share some historical context that informs these selling decisions, because I've made mistakes in the past by holding too long, and I'm determined not to repeat them. One of my biggest mistakes was holding U.S. Airways preferred stock too long. We bought it in 1989 when the airline was struggling. Got a good preferred yield. Thought we had downside protection. But the airline industry is brutal. High fixed costs, commodity product, powerful unions, volatile fuel prices, intense competition. U.S. Airways went bankrupt. We lost our entire investment. I held too long hoping it would recover. I ignored the reality that the industry economics were terrible. I should have sold years earlier and accepted a partial loss instead of a total loss. Another mistake was holding Tesco too long. Tesco is a British supermarket chain. We bought it because it was cheap and growing internationally, but I missed that the business was deteriorating. Competition was intensifying. The international expansion was poorly executed. Management was covering up problems. I should have sold when the first signs of trouble appeared. Instead, I held on. We ended up losing about $400 million. Not huge for Berkshire, but unnecessary. I held because I didn't want to admit I was wrong. Ego got in the way. These experiences taught me valuable lessons. Don't hold struggling businesses hoping they'll recover. Don't let ego prevent you from admitting mistakes. Don't ignore deteriorating fundamentals. Sell when the facts change. I'm applying those lessons now with Bank of America, Chevron, and Paramount. The facts changed. I'm selling. Not waiting, not hoping, just selling. Let me also address the tax implications of these sales, because taxes matter significantly when you're selling appreciated stocks. For Bank of America, our cost basis is around $7 per share. The stock trades around $40. We have over $30 per share in gains. On 1 billion shares, that's over 30 billion in taxable gains. At the 20% long-term capital gains rate, we'll pay about 6 billion in taxes. That's real money even for Berkshire. But here's why I'm willing to pay it. First, tax rates could rise. The federal government is running massive deficits. At some point, they'll need more revenue. Capital gains tax could go from 20% to 25 or 30%. Selling now locks in the 20% rate. Second, I'm concerned Bank of America could fall significantly if commercial real estate problems materialize. If the stock drops from 40 to 25, I've lost $15 per share, or 15 billion total. Paying 6 billion in taxes to avoid potentially losing 15 billion in stock value makes sense. The tax is a certain 6 billion cost. The potential loss is uncertain, but could be much larger. I'll take the certain smaller cost. For Apple, the tax situation is even more dramatic. We bought most shares at prices under $30. Apple trades over $230. That's over $200 per share in gains. We own about 900 million shares. Total gains are about 180 billion. At 20% tax, that's 36 billion in taxes. This is why I'm selling gradually. Selling everything at once would create a massive tax bill and potentially move the market. I'm selling 10 to 20 billion per quarter, spreading it over multiple years. This manages the tax hit and avoids disrupting Apple's stock price. The Chevron and Paramount sales are smaller positions, so the tax implications are manageable. But the principle is the same. Don't let tax considerations override investment decisions. Yes, taxes reduce your after-tax return. But holding a deteriorating business to avoid taxes is like refusing to sell a house that's on fire because you don't want to pay capital gains tax. You'll lose everything trying to avoid a partial tax. Pay the tax, sell the stock, move on. Now let me talk about what I'm doing with the cash from these sales. Because selling is only half the decision. The other half is what to buy instead. Right now, I'm not buying much of anything. That's why Berkshire's cash pile has grown to over 130 billion. I'm holding treasury bills earning about 5%. Some people criticize this. They say I'm missing opportunities. The stock market is up. I should be investing. But I see it differently. Treasury bills at 5% with zero risk is a pretty good return. The S&P 500 at current valuations might earn 6 to 7% over the next decade. I'm giving up 1 to 2% to have zero risk and total liquidity. That's worth it to me. Plus, I'm patient. Markets go through cycles. Right now, everything is expensive. But crashes happen, bear markets happen, recessions happen. When they do, great businesses will go on sale. I'll have 130 billion ready to deploy. I'll buy billions worth of stocks at 40 or 50% discounts. That's when I make my best investments. Not when everything is fully valued. When there's blood in the streets. So I'm selling Bank of America, Apple partially, Chevron, and Paramount. I'm raising cash. I'm earning 5% in T-bills. I'm waiting. When the right opportunity comes, I'll know it. And I'll have the capital to act decisively. Now let me give you very specific financial metrics that inform my selling decisions, because I don't just sell on qualitative concerns. I look at quantitative data. For Bank of America, here are the metrics that concern me. Net interest margin has compressed from 2.7% in 2021 to 1.9% currently. That's a 30% reduction in their key profitability metric. Return on equity has fallen from 11% to 9%, still decent but declining. Non-performing loans are rising, up 30% year over year. This means credit quality is deteriorating. The efficiency ratio, which measures expenses as a percentage of revenue, has increased from 58% to 62%. They're becoming less efficient. And the provision for credit losses has doubled year over year. They're setting aside much more money for expected defaults. All of these metrics point to a business under pressure. Margins compressing, credit quality worsening, efficiency declining. This is not a business I want to own at 1.3 times book value. For Apple, here are the metrics. Revenue growth has slowed from 9% annually to 5%. That's a significant deceleration. iPhone revenue is flat year over year. Services revenue growth has slowed from 18% to 8%. This was supposed to be the high growth segment. Now it's slowing too. The price to earnings ratio has expanded from 12 when I bought to 29 now. The valuation multiple has more than doubled while growth has slowed. That's backwards. Multiples should compress when growth slows, not expand. Operating margins are at all-time highs around 30%. This is good, but also means there's no room for margin expansion. Future earnings growth will have to come from revenue growth, which is slowing, and the Greater China revenue declined 5% last year. This is Apple's second largest market showing negative growth. These metrics tell me Apple is maturing. Growth is slowing. Valuation is high. The risk reward is less favorable than when I bought. For Chevron, the metrics are about the industry, not just the company. Global oil demand growth has slowed from 2% annually to 1%. It's decelerating. Electric vehicle sales are growing at 40% annually. This will accelerate oil demand decline. Renewable energy capacity is growing at 25% annually, displacing fossil fuels. The break-even oil price for Chevron to maintain dividends and capex is about $60 per barrel. Oil currently trades around $75. That's a thin margin. If demand weakens and prices fall to $50, Chevron has to cut dividends or capex or both. The 5-year average return on capital employed is 9%. That's mediocre. You want to see 15 to 20%. And Chevron's reserve replacement ratio, which measures whether they're finding new oil as fast as they're producing existing oil, has fallen below 100%. They're depleting reserves faster than replacing them. This is a business in long-term decline. For Paramount, the metrics are catastrophic. Revenue has declined 12% over 3 years. Streaming subscribers are growing, but at a cost. Customer acquisition cost is about $150. Lifetime value is about $400. But churn is high, around 6% monthly. This means the average subscriber stays less than 2 years. The economics barely work. Free cash flow is negative $2 billion annually. They're burning cash. Operating margins have collapsed from 20% to 5%. And the debt-to-EBITDA ratio is now 5 times, up from 3 times 3 years ago. The balance sheet is deteriorating. These metrics scream trouble. This is a business in terminal decline with worsening financials. No amount of operational improvement will save it. The industry is dying. Sell. Let me now contrast these selling decisions with examples of stocks I'm not selling and why the metrics support holding. Coca-Cola, for example. Revenue has grown steadily at 4 to 5% annually for decades. Operating margins have stayed consistent at 25 to 30%. Return on equity is consistently over 40%. This is exceptional capital efficiency. The dividend has increased for 62 consecutive years. Never cut, never suspended, even through recessions and crises. So free cash flow generation is $10 billion annually on $40 billion in revenue. That's a 25% free cash flow margin. Incredible. Coca-Cola has net debt of about $35 billion against operating income of $15 billion. Debt to operating income is 2.3 times. Very manageable. And most importantly, the business is global and growing in developing markets where per capita consumption is still low. The metrics support holding Coca-Cola forever. American Express shows similar strength. Revenue has grown at 7 to 9% annually for the past decade. Return on equity is consistently over 30%. This is world-class profitability. The efficiency ratio is around 35%, much better than traditional banks at 60%, meaning American Express generates much more revenue per dollar of expense. Card member spending grows mid-single digits annually, even in recessions. This shows the loyalty and affluence of their customer base. And the provision for credit losses as a percentage of card member loans is only 2%. much lower than traditional banks. American Express has a fortress balance sheet and a business model that generates superior returns. The metrics say hold forever. This contrast illustrates the point. I'm selling stocks where metrics are deteriorating. I'm holding stocks where metrics are strong and stable. Metrics matter. Pay attention to them. Now let me address a philosophical question about selling. If you're a long-term investor who believes in holding great businesses forever, how do you reconcile that with selling? Doesn't selling contradict the hold forever philosophy? Here's my answer. Hold forever is an aspiration, not a rule. It's what you do with your very best ideas. Business is so good, so durable, so well managed that you can't imagine ever finding anything better. Coca-Cola is a hold forever stock for me. I can't imagine a scenario where selling Coke makes sense. The business is perfect, the dividend grows every year, the brand is impregnable, the moat is wide, there's nothing better to buy. Same with American Express. The business model is superior, management is excellent, returns on capital are world-class. Why would I ever sell? I wouldn't. But not every stock is a hold forever stock. Most stocks are hold until circumstances change. Stocks, you buy them because they're attractive given current conditions. You hold them as long as those conditions persist. When conditions change, you sell. Bank of America was a hold until circumstances changed stock. The circumstances changed. Banks now face margin compression, credit deterioration, and commercial real estate risk. So I'm selling. Apple is in between. It's an exceptional business. But at 50% of my portfolio, concentration risk was too high. So I'm trimming, not eliminating. It might become a hold forever stock at a smaller position size, or I might keep gradually reducing. Depends on how the business evolves. The key is being intellectually honest about which category each stock falls into. Don't fool yourself into thinking everything you own is hold forever quality. Most stocks aren't. Be realistic. Hold the truly great ones forever. Sell the rest when circumstances warrant. Let me share specific advice on building a sell discipline into your investment process. Because most investors are much better at buying than selling. They research carefully before buying. But once they own a stock, they never reevaluate whether they should still own it. This is a mistake. Here's how to build sell discipline. First, set calendar reminders to review each position quarterly. Don't just check the price. Actually review the business. Read the quarterly report. Listen to the earnings call. Assess whether the investment thesis is still intact. Second, maintain a written thesis for every stock you own. One page explaining why you own it, what you expect to happen, what metrics matter, what would make you sell. Review this quarterly. If the thesis is broken, sell. Third, calculate position sizes quarterly. If a stock has grown to become too large a percentage of your portfolio, trim it. Don't let one stock dominate. Fourth, track key metrics for each business. Revenue growth, margins, return on equity, free cash flow, debt levels. If these metrics deteriorate for 2 consecutive quarters, investigate deeply. If the deterioration is structural, not cyclical, sell. Fifth, set mental stop losses based on business fundamentals, not price. For example, if a stock's return on equity falls below 10%, sell. If revenue declines 2 quarters in a row, sell. If debt to EBITDA exceeds 4 times, sell. Having these tripwires forces you to act when problems emerge. Sixth, use the airport test. If you were in an airport about to board a plane, would you buy this stock on your phone right now at the current price? If no, why do you own it? Sell it. This cuts through emotional attachment and sunk cost fallacy. Seventh, limit yourself to your best ideas. If you can only own 10 stocks, would this one make the list? If no, sell it and buy something better. Most investors own too many mediocre stocks. Concentrate on your best ideas. Finally, let me close with a reminder about the purpose of selling. Selling is not about market timing. I'm not selling because I think a crash is coming next month. I might be completely wrong about that. Selling is about risk management and capital allocation. I'm selling Bank of America to reduce exposure to commercial real estate risk and bank sector challenges. I'm selling some Apple to reduce concentration risk and take profits after massive gains. I'm selling Chevron to exit a structurally declining industry. I'm selling Paramount to stop funding a deteriorating business. These are business-specific decisions based on changing fundamentals, not macro market calls. This is important. Don't try to time the market by selling everything before crashes and buying everything back at bottoms. That doesn't work. What works is continuously evaluating your holdings and selling those where the fundamentals have deteriorated. This keeps your portfolio filled with quality businesses and eliminates the mediocre or struggling ones. That's the path to long-term wealth creation. Buy well, hold as long as the thesis remains intact. Sell when circumstances change, redeploy capital into better opportunities, or hold cash until they appear. Simple in theory, hard in practice, but essential for investment success. I'm 94 years old. I've been investing for 80 plus years, and I'm still selling when the facts change. You should too. Start today by reviewing every stock you own. Ask honestly whether you'd buy it today. If not, sell it. Build sell discipline into your process. And always remember, selling at the right time is just as important as buying at the right time. Master both, and you'll do very well over your lifetime.